Ready?
I've been ready for days.
Okay, well, you're in. I'm hearing
days.
me.
Okay.
Hearing me. March 18th, episode number 8. We are live back again. This is
Did you say number 8? We're at 8?
We're at number 8
Oh,
now. We're at
all
number
right.
8. So more to come, more to come.
right.
We've obviously had a lot going on with the banks in the US and Europe. So we have a 10-minute bank run special for you. Then we're going to get into some of those other topics. Do you have the quote of the day for us, Jerry?
I do have a quote of the day, and you have to be kind of a certain age to remember. It comes from a movie. I'm not even going to quote a person. It comes from the movie.
Okay.
You may have seen it, but the movie is called Cool Hand Luke. Paul Newman, George Kennedy actually won an Academy Award.
Yeah.
And in this movie, there's a famous quote where one of the prison guys who's in charge of all the guards there says, "What we have here is a lack of communication."
Isn't it? No, you messed up the quiz. What we have here is a failure to
Well,
communicate.
it's a failure to. I wanted to twist it.
You-
Okay. That's
it was
fine.
It was a Jerry twisted.
I wanted to
quote.
lead to this banking information was being published, but you're right. What we have here is a failure to communicate.
There you go. Okay.
That's the actual quote.
Sounds good. And we actually are coming to you live from outside of Silicon Valley Bank. Not
Oh,
really,
yeah,
but,
okay,
here
yeah.
we are there. And St. Patrick's Day, so happy St. Patrick's Day.
Yes, that's for sure.
Awesome. Let's get into it. Get into the bank run special here.
CJ Stevens and Jerry Kallitsis work for Investia Financial Services Inc. All opinions expressed by CJ and Jerry or any other podcast guests are solely their own and do not reflect the opinions of Investia Financial Services Inc. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Investia Financial Services Inc. may maintain positions in the investments discussed in this podcast.
Awesome. So we're into the bank run special. So we wanted to do a bit longer of a time here to go through kind of what's going on with a few of these banks and focusing more on Silicon Valley Bank and what happened with them over the last couple of weeks. And there's, of course, been a few more. Credit Suisse was in the news the last couple of days with their own issues and going on in Europe there. So we wanted to focus mainly on the Silicon Valley Bank and kind of going through what happened with them, and really was a black swan event. Nobody was predicting this. If you look back a year ago, I mean, even a month ago, nobody was really thinking that something like this was going to happen. And a few extenuating circumstances really pushed some poor risk management over the edge here. So let's take a look at the first thing was, even though having said that nobody was considering it, there was one article that came out March 2nd. This all kind of happened on March 10th, March 8th to 13th, in that range there over the weekend. But on March 2nd, an article did come out pointing out the U.S. bank deposits had fallen for the first time since 1948. So we were seeing that, bank deposits were coming down, and that's something you would expect when short-term bonds are paying such good yield right now that maybe people are moving their money out of parking it at the bank and into shorter term bonds to try to get a bit more return. This was also the first time that we had a bank run in the social media age.
And we have to make sure that we're clear here that we're talking about the U.S. banking system, which is completely different than the Canadian banking system. So even though the word bank is there, I think all of us are smart enough to know that the U.S. has a lot of private banks, and you see names
those
around.
regional banks.
They're just not the
Fifth
same
Bank
as
of
us.
Toledo was
Exactly.
was
so
one.
let's make sure we're clear on that.
There is that difference. Yeah.
There's a significant difference in regulation and how they conduct theirs versus ours. So
well, and I think this was more of a a situation of poor risk management here, where Silicon Valley Bank in particular really mismanaged their risk and ended up paying the price for it. And I think we're gonna show a few charts to kind of walk through what happened here.
And I have to be clear that Jerry did not know who Silicon Valley Bank is up until 2 weeks ago. So
yeah, we
it
really
isn't
hadn't
like
heard.
I knew.
I mean, but yet it was the 16th largest bank in the States, and had a lot of assets. Over 200 billion was the value, and Credit Suisse, they're 500 billion, so they're even larger. But the Silicon Valley Bank was still big. So the chart we're looking at here is the yellow line is total deposits at Silicon Valley Bank going back to 2018. And when you look at that yellow line, what do you notice, Jerry?
What do I know? Is it's going up in the last little while? It started to
come back
come
down
a bit.
And right? I think we saw that in Q4 2020, 2021, where tech was really booming, and we heard about SPACs all 2021 and those types of things, of venture capital funds. So as those were booming and doing well, that's the main client of Silicon Valley Bank, is young tech startups and venture capital firms. So,
and some cryptocurrency exchanges are in there, all kinds of different stuff that we're not used to, again, on our banking side, right? So
and it's so I think that as those companies were doing well, they're getting money, they're bringing money in, they're bringing rounds of funding in, and they're depositing money hand over fist. So you can see that we kind of peaked as the market peaked as well in 2022, and deposits started to tighten up. Now, these young tech startups and they're they have a lot of expenses. So you got payroll expenses, you have all that. So they do drain a lot of cash as well. So when that money's not coming in, and they still have to pay their payroll, they still have to pay their expenses, they need to withdraw funds. And they deposited the funds in a bank, so now they need to withdraw them. So now, if we're looking at the bars there, you can see that lighter blue line or the lighter blue part of the bar is available for sale securities. And they're much more liquid securities in there. And when you look at that, it's less than 30 million that they had in available for sale securities. So that would be the first thing that the bank would use when clients are withdrawing funds. Now, that the darker blue part of the bar is the held to maturity securities. And so that bar there, you can see that growing as well. So as the deposits were coming in, the available for sale securities weren't really changing, but the held to maturity securities were changing. And those are more long-lived assets. So more to come on those on the next chart. But then they were forced to start selling those held to maturity securities there. So now we got a bit of an issue here with all the held to maturity securities, and that issue is shown on this chart here. The losses, if you look at the right side there, those are the losses on the held to maturity securities for Silicon Valley Bank.
They're forced to sell them because people are asking for their money.
Exactly.
Okay.
Yep. And so to get into it, what happens is they need capital. So now they have a mark to market on the held to maturity. And JP Morgan came out and said I'll just read the quote here, selling held to maturity securities results in larger parts of the portfolio being suddenly marked to market, which can result in the need for a capital raise. So when you have these held to maturity securities, these were long-term bonds. This wasn't subprime mortgages or anything. These were government-backed treasury bonds that they were holding. But if rates increase, the price of your long-term bonds decrease. So the value in the interim before maturity drops, and it can drop substantially if you have a big increase in rates.
Which is leading me back to your buddy Jerome Powell, who is going to decrease rates.
Wait a second. Later. We've talked about the risks of increasing rates at the dramatic speed that he did, and the unintended consequences. I guess I would assume unintended.
I'm trying to hold back. I'm trying to be calm.
Well, let's stick to
the guy in charge in controlling risk.
Yes,
was not there, and these long-term bonds, which are safe in terms of where they're invested, they're safe only from the angle that that light blue bar before we have money to pay people off, and all of a sudden there was a massive amount of people wanting their money because of fear of what's going on.
Yeah,
So
and I think that even though there is losses there, this chart's showing the unrealized losses, and of course, now that people are pulling money out, you have to realize those. But there is value to those holdings because once they mature, the bonds mature at par value, so there is value there. It's just if you have to sell them in the interim, the price of the bond is down because the rates went up so huge. And this chart shows the pretty staggering amount of deposits in a 24-hour withdrawals in a 24-hour period here that SVP was faced with. So again, like you said, poor risk management and not accounting for the fact that the tech slowdown and the amount that these companies burn cash would create these outflows without the deposits coming through. But $42 billion, and this is a $200 billion bank, $42 billion in attempted withdrawals on March 9th in a 24-hour period. That's a lot. And I think as much as Silicon Valley Bank certainly was mismanaged, when you get a run on the banks here, any bank does have risk when they have such a dramatic portion of their deposits being withdrawn. Would you agree with that?
yes.
Yeah, so I think that's the scary.
If you went to the Royal Bank and trying to get that amount of money, they too would have a problem. They would have to go and do something to do it, right? Nobody's questioning that part of the equation. You can question is, why do people want their money out? What's the reason that this massive amount of money was requested when you clearly show the history that it never was like that before?
Well, and that's the thing is as soon as that snowball effect starts to happen, and social media really exasperates that and highlights that because word gets around quick, right? And especially with you add in that they're tech companies and that as well, word gets around fast. And then you add in, as we said, this is the first one in the social media age, the technology age. You can be sitting on your couch
Exactly.
and hit a button and
let's remember, they're not lined up
transfer your
around a
money.
bank asking for their money. These people are in their basement clicking a button, and that's how that 42 billion just kept accelerating.
Yeah. So and so now, what happened? How did it all shake out, and where are we at with it now? So here's the portion. So FDIC insurance is the coverage that that the states has for their banks. Of course, it's CDIC coverage here in Canada. What's that? Canadian Deposit Insurance Coverage. So what that is in the States, they cover $250,000. So if you have $1 million deposited at Silicon Valley Bank, only $250,000 is insured if Silicon Valley Bank goes under. In Canada here, if you have $100,000 in your checking account at RBC or wherever, or one of the big banks, that is covered through CDIC protection. So if RBC goes under, your $100,000 is still secure. If you have $1 million in your bank account, that $1 million is not secure. So what this chart is showing is that only 12% of Silicon Valley Bank's deposits were FDIC insured. So very small portion, which was the worry on Sunday night, was that, okay, if the government, central bank, Fed, doesn't come out and say that they're going to insure and protect and make sure
The depositors,
all of the deposits are covered, not just the $250,000, more than that was covered, then I think there was that fear that, you end up in a potential blood in the streets scenario here where people start going, okay, holy smokes, if Silicon Valley Bank, their money wasn't protected, well, I need to take my money out of where my bank is and move it around, shuffle it around. So then you get financial contagion coming through, and that's when the run on the banks start, and it starts getting much worse there. So I think what they did was a bit different than 2008, but it's certainly, whether you agree with it or not, it's certainly protected against that run on the banks extending even further?
I'm trying to pretend I'm the person who doesn't know anything, standing in the middle of the street, and in a matter of, I don't know, we'll call it 2 weeks, Silicon Valley made the front page news. The next thing I know, Signature Bank disappeared, another one of these on the list. Then I see Silvergate Bank, the same thing, their deposits. And then the latest one, before we even get to the credit guy, Seuss one, etc., the First Republic shows up. And that's the one that caught my eye, because immediately, like you said before, people are taking their deposits out and making sure they're splitting 250, depositing all over the place, 250, just to make sure they're covered. Well, I read the headlines, I read the news, and then I read that First Republic received $30 billion of money to tell people, hey, relax, everything's okay. Well, where did it come from? So
yes, that's capitalism at its finest.
Then I see where it came from. And just to make a quick summary of it, $5 billion came from Bank of America, Wells Fargo, Citigroup, JP Morgan. They all chipped in $5 billion. Those names we all recognize because they're the big boys.
Yes, yeah.
And then $2.5 billion came from each of Goldman Sachs and Morgan Stanley. I recognize those names too. And then $1 billion came from Truist, PNC, US Bancorp, State Street, Bank of New York Mellon, names that are not as recognizable. So I'm thinking, okay, so they take their deposits out and they deposit them back into the bigger boys, into the.
Well, it's so, if you picture the customer that's of First Republic, and then they go, I'm worried about my money being there.
I better move it to Bank of America.
They go and they move it to Bank of America, and then Bank of America grows in their deposits, and then they go,
take it and say, let me help you out, First Republic.
First Republic, let me help you out. And Bank of America gets richer because they're not giving the money to First Republic unless they help.
And then Jerry, who is of an age where he always squints his eyes and tries to figure out what's going on over there. So I look up First Republic, who I've never heard of before either. So it's not like I'm an expert, because I'm not. I know nothing about them. I find out they're supposed to be in the S&P. They're the only S&P company that is not reporting to the SEC, the Securities Exchange Commission. I'm thinking, what? What is it? So they report somewhere else. Then I find out their executives, the people at the top, and one guy's name is Lichtman, and I'm only reading what I read. I'm not making an opinion here either way. I find out he and his wife redeemed $2.5 million each in the last a couple of weeks before this thing happened.
Yeah.
And a bunch of money. So it just smells. It makes people skeptical.
Silicon
CJ.
Valley Bank, was I think in a similar boat where there was some shares sold.
Well, it just makes it look fishy, and people get skeptical. And I don't blame people for taking their money, moving it because they're fearful. So I don't know how the U.S. does it, etc., but it just didn't feel good. So This made the front page news. Something about what we have here is a failure to communicate. I just bring that to your attention, that I'm not sure what's going to happen here, but it just doesn't feel good, right?
Well, and I think kind of moving into the next topic, we'll segue into that topic, which is chatting about the stock market. So let's get into that here.
And that leads to the stock market, actually.
And part of that is it's interesting to see that banks failing is bullish for the stock market. Do you think? I mean, there's that potential there that we live in such a strange time right now where that would be actually good for the stock market, because that would mean no more rate hikes, rates coming down, maybe potential rate cuts being priced in, that kind of stuff into the stock market. And it's an interesting position to be in, where that could actually be good for stocks to come in. A loss of trust in the financial system would certainly be deflationary, but we do have inflation on the list, so we can talk about that after. But yeah, it's an interesting thought.
And how convenient for Mr. Powell that this happened so that they can
Well, it did
take the
happen
spotlight
because of
off
what he
him.
did. So, I mean, it
No,
wasn't.
but take the spotlight off him.
It takes some of the heat because now something's broken. But could it be that is it?
His fault that it happened.
Well, and is it a systemic issue with all the banks being, having less liquidity and being at risk here, or is this kind of a washing out of the inevitable, bad companies that end up from such a long bull run that we've had
Right, and bad
over the
companies
years?
should be more thoroughly.
On the market front, we're looking at a chart of the S&P 500 here, and this goes back about a year, goes back to May, late April, and it just kind of showing how
There's been a lot of noise, but not a lot of action.
there's not, it's very up and down. It's, up, down, up, down, up, down, but really trading within a 10-15% range there, up and down. I feel like the market just does not know what it wants to do. It's not sure if the market likes certainty. It likes to know, are we going to be raising rates continually? Is it going to be 5% for longer? Are rates going to be cut? So we've had a lot of uncertainty with regards to that over the last year, of course, and the recession side of things.
So did you say there's a failure to communicate of what's going on? Is that what you just said?
There's really a failure to communicate
Okay,
here.
good,
So it's interesting to look at that, just thinking about, where is that going to go? Is it going to go above or below? And hopefully we go above that. But it just seems like we're stuck in no man's land here
until
over
we
the
get
last
some
year,
direction,
until
some
some direction happens.
Yeah.
With the kids, I think it was Three Little Bears. Is not too hot, not too cold. That's kind of where we've been trading at over the time. And also, if you think about what's happened over the last, few years, all the stuff that's gone on in the world here, pandemic, everybody working from, lots of people working from home, businesses shut down. You have Russia-Ukraine war, supply chain issues, historically fast rise in interest rates. And we've still maintained trading in this band over that time, which kind of leads us to, hey, you know what? In history, there's always a reason to not invest, and there's always a headline to not that worries people, try to keep you from investing. But I think over time, if you have that long-term outlook, as we preach, you can make money. So what this is just showing is the events every year going back to 1999, and the cumulative total return since that headline happened. So in Y2K in 1999, the S&P 500's up 467% since then.
I'd just like to point out that you seem to 2011. You're once again you make a low blow on 50% write down of Greek debt.
Well,
and then the next year you simply say, "Oh, we give them a second bailout." I'd just like you to remind you that this past year was record number of people going to Greece and the islands. They've never seen this much. Maybe it's pent up demand of going, tourism, etc. So I just like to point out that
so Greece is back.
Greece is doing just fine.
You're wearing your blue Philotimo.
I'm just letting you know.
You're wearing our team hoodie
Stop
today,
picking
representing
on Greece, because Greece is doing just fine. But anyway, go ahead.
Overall, what we wanted to show here was just the fact that there are always short-term noise headlines that are plastered in newspapers and on the news, and reasons to not invest. So we don't like to look too much in the short-term noise, although we do follow that.
And I will add one more point to that is, on each of those, you pick one. You go to 2008, global financial crisis in 2008. The world was coming to an end. We were done, finished completely, and yet we're still standing here. So every time you have one of these events, as bad as it is, time usually solves it. Policy, banking, they do what they have to do to fix it. And even though I'm not happy right now with the way things are going, I still do believe they will fix it. They will do what needs to be done and correct the direction we're going. I just don't know how and when, and that's why we're having these discussions right now.
Definitely, because the short-term noise is out there. So we're you try to follow it, and you try to figure out, what is going on and what are the longer-term effects of those types of things. So moving into our next topic here, we have mortgages. So we did want to chat about, obviously, with all this stuff going on in the banks.
Yeah. So what's Jerome Paul going to do, CJ?
Well, it's Jerome Powell and more for
Huh.
us here in Canada with mortgage rates. What TIF is going to do as well. So I
Okay.
think, what we first
Tiff
wanted
paused. Tiff paused. He said he was going to
TIF
pause,
paused,
and
yeah.
he did. Right. Okay.
Yeah. So in terms of what the two factors that play into how mortgage rates are determined, let's say. So how does a bank determine the mortgage rate? Well, first off, they look at 5-year Canadian bond yields. They tend to track with the mortgage rates. And so if I get this up here. Here's that chart there. So when we're looking at the 5-year conventional mortgage lending rate in orange at the top there. So I think we've showed this chart before in a previous episode. And I think we showed it at the beginning of March when you kind of see that peak there now. And we've come down substantially since the banking crisis has hit. So what you're looking at there is the 5-year bond yield in Canada going from about 3 and 3.75 down to 2.85%. So quite a substantial decrease there in the bond yields. And if that holds, we've seen that fluctuate, but if that holds lower,
you would expect
that mortgage rates are going to come down. So, are they coming down to the 2% that you got? No, they're not. But could they come down from that 4.7% below 4.5? I think that is a potential.
It kind of hinges upon these last 2 weeks with the banking system in the States that's made the front page news. What happens to it? If it stabilizes, then maybe this becomes a non-event. If it lingers on, then you're right. There is a serious chance that
Well, and bond yields
soften.
can go up if inflation comes back up, and so those can certainly fluctuate. But one factor, we did talk about it before, and we've seen a pretty dramatic decrease in that. You see that sharp decline there over the last couple of weeks. So positive if you're looking to get a mortgage.
Well, you certainly hope it's positive because that's what it's showing.
And the second thing are these benchmark swaps. So benchmark swaps are what banks use between each other to manage their interest rate risk. So one bank agrees to pay a fixed rate to the other bank, who pays them a variable rate back. And the whole reason they do that is because they might have too much exposure to one side or the other. So to manage that, they utilize these benchmark swaps. So that's a little bit.
So they loan money to each other.
Exactly.
And on their books, they're protected because
end of the year, one bank does better than the other bank, but the other bank that doesn't do it better in that transaction doesn't care because they had overexposure to the thing that did better. So it's just about managing the interest rate exposure for these banks. And mainly what we want to show here is the decrease. So you can see the benchmark swap rate is currently highlighted there for 5 years at 3.128%. That's down from 3.7% in February. So you can see that rate has also come down quite substantially. And according to a good follow on Twitter that I track, a Canadian at TableSalt13, he posts a lot, or I'm not sure he or she posts a lot of interesting stuff about Canadian rates, and that is so a good follow on Twitter there. But showing that potential drop in the 5-year fixed mortgage rates if that can hold. So something else that we're keeping an eye on and watching is that there. And now to go into this chart that we put together here, the percentage of mortgages that are in arrears to the total number of mortgages is the green line you're looking at. So a very positive, I know, Jerry, you think this is very positive. A very positive,
I do,
something to see here is that the percentage of mortgages that are in arrears to the total number of mortgages is at all-time lows here. You can see that line clearly going down. This goes all the way back to, I believe it's 1980 there. On the chart. So the blue bars are the total number of mortgages. The green line is the number of mortgages in arrears.
So if the rates stay the same or inch higher, it'd be interesting to see what this chart shows in 3 months from now, 6 months from now.
Well, definitely, it's
So because the people in the last 2 years, 3 years, they're having a tougher time, but they're still paying. They're still paying their mortgage, like we've discussed this numerous times.
yeah, because basically this is showing that Canadians are
still
being
paying.
are able to keep up with their mortgage payments, which is a positive factor. Of course, we're not in that recession yet. We haven't seen unemployment go up, so those would be two factors that would likely push that number higher, right?
Correct. And the fact that they're paying their mortgages, even though it's costing them more, they may be cutting back on something else, which is not really shown here.
Well, and that's the
So-
trickle effect. You have to, exactly. You're right. You have to, in order to continue to pay your mortgage, you have to give something else
Correct.
up, right? So the last one we wanted to show here for just mortgages and housing prices was, I do like that. This one was for Jerry here.
And this is just to tick me off, right?
This
I know.
one
Go
is
ahead.
for
Go
Jerry here.
ahead.
I just wanted to read the exact.
I'll let you talk
stat
first,
here.
and then I'll give you my rebuttal. Go
It's
ahead.
so what we're looking at here is the actual, not seasonally adjusted, the actual national average sale price for homes in Canada. So the national average sales price. And if we go to the far right side here, Jan 2023, March 2023, February is the latest one on that chart there. 19% year over year decline in February for the national average sale price of homes in Canada. So
What's the average
biggest
here over
drop,
the last 20 years?
the
or
biggest
18?
drop in
What's the average over the
housing
last...
prices. Wait a sec. The biggest drop in housing prices in Canadian history
Yep.
year over year there. So housing prices certainly coming down,
It looks like...
clearly coming down.
When do I get to talk here?
Go ahead.
So it looks like if I run a line across that whole spectrum of chart from 2006 to 23, it looks like
Well,
it runs at 15, 17 if you draw a line across. So it looks like
What?
from
What do you mean?
21 to 22, there's a big
Oh,
mountain.
from
There's
20
a big
you're-
mountain
sorry.
climbing here number.
So you're saying the average from 21 to 22. Gotcha. I thought you were saying since the start. Yeah.
No,
okay,
does it
I'm
not
with
look
you.
like there's a really
there's
steep climb?
there's certainly a number of the months in there that had year over year percentage changes.
No, ridiculous percentage
over
change.
20%.
Ridiculous. 20. You've hit 30 on the peak there.
Two of them hit 30 in the
Okay.
peak. Yeah.
So if we remove those peaks, that would then remove the decline of 2023 on the average. If we were to remove them, so we want to emphasize that the market's down 17 and 18%.
18.9.
Maybe because it's down 18%, because it was a ridiculous run up of 25 and 30%.
Well, I think the positive news for Canadians that want
If you
to
own
buy
the house,
a
you
home,
watch your house go up and you're happy.
Canadians that purchased a home in 2022, are down right now on the house. But when you look at this year over year, the averages since going back is positive for homes, which is good. But I think it's also good that I think we're agreeing in actual fact that we are seeing housing prices coming down. So we're seeing housing prices coming down, shown in this
because
chart
they were
here.
at ridiculous.
But they're still
heights.
coming down. They're still coming down, which is positive.
I've used this
Like it's
example
positive.
with you.
It's positive in the sense that you're getting a more fair value for the house. You're not getting the elevated value for the house, so you're not having to get into those bidding wars as much anymore and things like that, because housing prices aren't going up 20 and 30% year over year.
Which we knew was unsustainable, right?
But wouldn't this chart, I think what I'm saying is, wouldn't this chart look worse if we weren't seeing, we would be more concerned about the fallout if this chart was not showing that housing prices were coming down. Is that fair to say? Like if year over year percentage changes in homes was still positive after that amazing run that housing had for 2020 to 2022,
we would have a much more serious problem.
we would be more worried about the fallout. So we're in the fallout right now.
I think,
again, biggest drop in house prices in Canadian history here, 19% year over year.
I think you've emphasized the the actual wisdom and conventional wisdom factor that you keep emphasizing to me. What I'm trying to say is pre-COVID, which seems like a million years ago, but even if we go back 5 years, if a house cost $500,000 and it was growing at 3% a year, whatever the number was, and over the next 5 years, it grew at 8, 10, 12% a year. And I'm making up numbers here, but it pushed this number to $1 million. And then over the next short time through interest rates, whatever, oh my God, we're down 20%. So now the house is $800,000. For example, I'm just picking random numbers.
It's still not, cue it, say it.
What I'm not, don't say reversion to the mean and get me annoyed.
Well, that's what you're describing.
It is a reversion to the mean.
That's what you're describing.
Well, it is a reversion to the mean because 5 years later, if that house now is worth $750,000 and you go, holy mackerels, it's down 20% from its all-time high. Jerry says no, because the reversion to the mean means it should have been at 690. It's still above average, even though, yes, people have suffered who have purchased a home in the last 2 and 3 years.
I think the problem with reversion to the mean is that what mean are you using? Are you using the mean average increase in home prices since 1900? Are you using the mean average home price since 1980?
This is the problem with young people like you. You get to choose whatever block of time you like. Well, older people like me tend to use numbers that are
sweeping general statements and be like, I'm older. So
we clearly disagree on the definition of reversion to the mean. I'm not trying to go back to 1900s. If I go back 50 years and I see it's been going up 3% a year and we have a stretch of 5 years of going up 10 and 12, I say something is wrong with the 10 or 12. That's all. So I'm not saying it should be 3, maybe it should be 4. But I'm saying the stretch of time of going up 10, 12, 15% is ridiculous, is unsustainable. And your chart just shows me when you're down 20% that it was unsustainable. And when you factor in the interest rates and all the other variables, it just makes my argument look way better. Way better.
Your
way better. But anyway.
So we definitely went over here, but this was a big topic as well. But I think if we could do an overall here. And you tell me if you disagree.
You got to blend in more. Then you got interest rates and inflation.
Well, just
inflation hasn't gone away.
No, but just wait. This is what I'm saying. So just wait. So what I'm saying is that if you're a Canadian that owns your home or you're Canadian looking to purchase a home, I think what we recommend is to find the right place in the right area that you can stay in for longer. So don't try to time the fact that housing prices are overvalued right now and interest rates might come down and those types of factors. You certainly have to factor those in when you're making your decisions. But you really need to, don't put it off if you want to become a homeowner and you have money and you need to find the right place. Focus on that aspect of it more than trying to time the fact that you think the market's going to come down. So you're waiting another year. Would you agree with that?
I do agree with that. I think I agree with the fact that do you want to be short in real estate? So, I know that sounds like a crazy term, but, I'm going to wait till it goes down or I'm going to wait for the right price. There is an intangible value of owning a home and being in the right place, raising your family. There is value there that doesn't equal money, doesn't equal the money part of it. I get that. I personally, me, I don't like people having an excessive debt just for the sake of owning a house. So there is the balancing act. You factor in where am I going to be with regard to my job? Jobs change all the time. People are moving around. Yeah. So there's other variables too. Like I get it. I certainly hope that interest rates.
Well, and you can, if you don't own a home and you think that housing prices are going to come down, so you're going to be able to buy a cheaper house, and they don't. They continue to go up or rebound and start going up again. Now all of a sudden you have to buy at a higher value, and that amount could technically go up a dramatic amount. I mean, we saw that from 2015 to 2022, just the dramatic increase there. So if you thought this is unsustainable, I'm going to wait you'd be waiting a decade to try to get back into the market, right? So you do have to consider that your home is not necessarily an investment. Everybody wants to make a good investment, but you do need somewhere to live, as you said, right?
I've never said that a home is an investment. That's for sure.
No, sorry, like as you've said,
right. Yeah. Like I've always said that,
you
a
need
home,
somewhere to live is what you say. Yeah.
And a good place to live where you can enjoy where you're living.
Yeah.
Exactly.
And next week might be a good time to challenge your mortgage broker. If you do have a variable rate mortgage, might be a good time to look into what you could lock that variable rate mortgage into.
So you're trying to wiggle out of this Bantering Bosses episode.
We are going for half an hour on more.
Is this a number 9? What number are we at?
We're at 8.
8. So you still haven't given me your prediction, because both of us don't know what's going to happen with interest rates and with inflation.
Okay, we're
all
going
of a sudden,
into that.
You haven't given me the conclusion.
We're
here.
not. Well, what do you mean? What do you want my conclusion to be?
I want to know what your thoughts are here.
My thoughts are, if you have a variable rate mortgage right now, I would be contacting a mortgage broker or your bank to ask what rate you can lock into for a fixed rate mortgage over the next couple of weeks, and thinking about taking that option, because if we do see fixed rates come down, you might be able to lock in at a rate, either a 3-year or a 5-year, where then at least you have some certainty after a couple of years. If you have a variable rate mortgage, after a couple of years of uncertainty, I'm sure rates could come down, but I think it is worth taking a look at getting into.
There's nothing wrong with gaining that information. I agree.
Exactly. So, okay, are we good there?
Go ahead.
So
you're just trying to get my blood pressure up. Go ahead. This is obviously a little bit longer.
Yes, I mean
session.
the mortgage one was longer, the bank run was longer. So we got a couple specials in here for you, a little bit more bantering here. But let's go into interest rates and see if we can hit this 5-minute target here.
Why do you keep bringing me Silicon Valley every time?
Well, Silicon Valley, we're live outside Silicon Valley.
That was the thing.
So talking about interest rates here and what's going to happen with that, across the board collapse in economic data. PPI is down, core PPI is down, retail sales down, New York Manufacturing Index down, core retail sales down. The economy looking weaker especially after these bank failures.
How convenient for Mr. Powell. Perfect. Okay.
Convenient. Yeah. And we do like to look at this. So when we've dubbed this chart the shadow Fed chart, this shadow central bank chart. So when you see that blue shaded area above the orange line is the 2-year treasury rate. So last time on the podcast, we talked about the increase in the 2-year getting back above where rates are. Since then, again, that sharp decline here over the last week with what's going on with the banks. So that blue needs to be outpacing that 2-year. And every time the orange is crossed with that blue, we've seen more of soon after seen a pause in rate hikes. So when we're looking at, what's going to happen with interest rates, well, we're looking at likely, according to this, likely soon to be a pause. Looks like he's going to do 25 basis points next time. But
you changed. I thought it was 0. You were
no, I said 25. You said 50.
It should be 50.
I said 25. Whether it should or it shouldn't be.
Okay.
I mean, so anyways, this is a pretty rather sharp decline here. So, and that is shown here. This is that decline in 2-year bond yields, which is the orange line from the previous chart here, and just showing how dramatic of a decline it is versus a couple of the other major events that have happened over the last 20 years. So you see COVID lockdowns there, oil collapse. So, that 2-year bond yield 3-day change is approaching over 70% decrease in a 3-day period, which is, again, unheard of. So
it makes the financial crisis look like it didn't exist.
Well, and this certainly isn't good news, because even though rates are going to maybe pause or not be hiking as fast, the reason that happens is because these numbers don't look as good and the economy doesn't look as strong anymore. So some of these things that are going on with the banks show some of the weaknesses, magnify some of the weaknesses in the economy. So
yeah, that's pretty amazing for a 3-day change. But anyway, okay.
Yeah, and again, everything seems to be, I guess if I could go back to this point, I mean, everything seems to happen faster now. I mean, you see the market come down in COVID in March, and it rebounds in a couple of months. Like, things just happen faster now. The run on the banks happens in a day, 24-hour period. You get $43 million, whatever that number was, requests and withdrawals coming through. So everything just seems to be happening a bit faster, including the change in the federal funds rate, which what you're looking at here is the increase of the central banks, the Fed in the US. And the red line there, which you can see is the steepest, sharpest, is the 2022 increase here. So going from near zero to 4.5% in less than a year has just the quantity and the short
pace,
time, the pace and the quantity are at unprecedented fast rates.
And maybe they're a precedent factor because we've grown at a ridiculous pace as well, in terms of what's happened with assets, with everything else. I'm always going to go back to inflation because, like I said before, you have no idea what inflation is, so therefore I have to kind of lead you. Yeah. So my argument that is, as steep as that is, it's probably not steep enough because it should have started way earlier and climbed it.
Well, I mean, it could have started earlier, and then it wouldn't be as steep.
Right, but it didn't.
Like, it wouldn't be as steep. So
it didn't
it's not necessarily
because
that
you guys wanted
steep.
low interest rates to keep things flowing.
Who's
but
you
anyway,
guys? There's no you guys.
There is
here.
you guys,
Okay.
But keep going.
There's no you guys. Let's go into our last topic here. We might hit our first 1 hour podcast here, Jerry.
Well, I'm trying not my best to be rebuttaling back to you on certain things, but your charts are charts.
Yeah,
I know. I get it.
It's good to show. I mean, it's good to show the charts to have we want to have something that we're chatting about that kind of starts the conversation type thing. And we do like facts here.
And we don't want to just go on what Jerry's thinking is
we
what
do
you're
like
trying
facts
to say.
here,
I understand.
exactly.
Okay.
So heading into inflation here now, the first chart that we wanted to show here was core inflation in Canada and the US is the thin line, and the regular inflation rate is in the darker line, Canada in red, US in blue there. So this is the percentage from the all-time highs. So you can see from this chart, around July 2022, inflation peaked out for most of these. And we can see the decrease, the percentage off that high, that inflation has come down in the 9 months since most of those factors peaked there. So a good chart to show how inflation has been acting over the last 9 months. And Jerry, when you look at that chart, how would you say inflation's been acting?
What I would like to say is what we have here is a failure to communicate. You show me core inflation, X farm inflation, X wages, exclude gas, don't put bananas in on that chart.
No, this is core inflation and inflation.
The point is they get to choose whatever. Is inflation coming down? Sure.
Well, I think the distinction to make is that there are some things that are still going up in price, but overall inflation is coming down.
Food is not coming down, and last time I checked, everybody requires food.
But what do we care about if everything else is cheaper?
Has gone down to $75, which or whatever I don't even know what that number is.
So gas is cheaper, but you do still pay an elevated rate for your groceries. That's for sure.
So people in general don't feel like things are getting better yet. And yes, maybe your chart is saying that they are, but it's not yet felt in the economy. This is what I'm trying to say. So back to your...
Facts don't care about your feelings, Jerry.
I know. You've mentioned that before.
But yes, I mean, on that note is something that we definitely want to talk about. So we are, in agreement. We are in agreement that, there are certain elements that make up inflation. And although, what are central banks looking at? And for the average Canadian or for the average person, what is actually going up, right? So that first colorful chart there shows the blue. So that shows the same inflation chart there, but just shows the components, the top line contributions to the inflation number. So services, which does not include food and energy, you can see is that blue line at the very bottom there. So services is what's really kicking up and maintaining inflation at a high rate there. As you can see, it makes up a large portion, larger than in the past year and a bit than it has. So we've seen the goods, the red, come down. We've seen the green, energy costs, come down. But food, as you said, has gone up since in 2022. And although it's not continually increasing, which is positive, it has stayed at these elevated prices.
Is that another way of saying it's not coming down?
Well,
is that what you're trying to tell? I'm not sure what you're trying to tell me here.
Yeah, that's what I said.
Okay, so in other words, it's not coming down.
But
it's already high, which means people are still feeling it.
People are certainly still feeling it. And when you go to the grocery store, it's, it is tough. And for people that are on stick to a budget, for people that are on a budget, it's something that is a mandatory cost. You have to eat. So seeing the price of food stay elevated like that is certainly not good for the economy or for average people, right? But the services is what is really driving up inflation here. And so now we go down to that second chart. So we see the top 5 individual contributors to the U.S. headline inflation year over year percentage. And we do see that shelter is making up a big chunk of that, again in the blue there. So we see the dark blue, rent of shelter is making up a large portion. So we've heard of the used cars. We're not seeing used cars up anymore. Motor vehicle insurance, electricity, new vehicles. We're not seeing those things, growing, but we are seeing the rent of shelter growing, which we talked about before, is a lagging indicator. It's they're looking at shelter costs from 6 months ago. It doesn't necessarily reflect the costs now.
Right, because now it's worse. So therefore it would have been a steeper climb, but we'll leave it at that. Okay. Keep going.
So is in terms of wage growth. So when we talk about sticky aspects of inflation, wages is definitely one of the stickiest
key components of inflation.
Well, it's one of the stickiest, that's for sure. And it can have a dramatic effect, especially at the tail end of the cycle as inflation appears to look like it's going down. Wage inflation you usually don't get until the end of the cycle. And so what we see here is we're looking at real average hourly earnings since 2007. And you can see the highlighted red part on the right-hand side of the chart is showing that real average hourly earnings are down over the last 2 to 3 years here. The last 2 years, I think it was 92 straight weeks. So just under 2 years, 92 straight weeks.
I read 93
of
right,
negative inflation. So,
but this is all jobs, right? This is all jobs. Like this is everything.
Yeah, and basically what this means is what this means is real hourly earnings are the earnings that you receive after adjusting for inflation numbers. Wage inflation is the rate at which wages are increasing over a specific period of time. So we would assume that wages, real average hourly earnings, are not keeping up with inflation. That's why you're seeing it negative when inflation is higher. So one of the things that happens when the real hourly earnings go down is you don't have as much money to spend on groceries as you did before because your dollars are worth less that you're earning, right?
So Meta or Facebook, whatever those guys are called now, when they just laid off 11,000 people, are going to lay off a bunch of more people. Those jobs are not minimum wage $14 an hour jobs, right?
No,
but
but
those jobs are $80, $90, $100, $150,000 jobs that disappear, that also have an effect on wages.
Well, and if we think of it this way, think of that you have $100,000 of income coming in, and that's your salary. Well, inflation is 8% last year. So unless your salary went up to $108,000, your salary was not keeping pace with inflation,
Correct.
Right? So that's what this is showing there, that salaries are not keeping pace with inflation. And the problem with that is that you want to go to your boss and say, well, I want a raise. and your boss has some uncertainty about what's going to happen in the market, so they're reluctant to offer you that raise to keep up with inflation. So is inflation transitory, or is it going to stick around? So you don't get the raise from your boss. So that's what this chart is showing. But in the long run, what happens is workers will eventually be able to demand, listen, inflation's been around. I need to at least keep pace with inflation in order to keep feeding my family, paying for my house. So then they kind of tie the hands of the employers and force them to increase their wages to keep up with inflation. Or, hey, I'm going to go over to XYZ company across the street because they're offering me higher wages. And then you get this wage inflation that increases, and that's when you get that rebound inflation effect, and inflation numbers start looking hot because of the wage inflation. So something that definitely to keep an eye on, and something that we would be concerned with the late cycle inflation here is something that could increase it in the future.
And it's not like those workers are going to say, oh, inflation's under control, let me give you back the raise you gave me, and so we can keep everything's under control.
Which is why it's sticky. It's
once
why
you
it's
give
sticky.
it, once you give it, it's done.
Yeah.
You don't get it back. And that's the problem that we're having. So
100%. So a few things we're looking at. That was certainly a long one, but hopefully you're finding value in that and good conversation.
Just for the record, this thing ran just over an hour. So when the editor, which is not me, edits this, and it goes down to 57 minutes, I'm pretty sure the 4 minutes will be mine that have been removed. Have a great day. And
Thanks for watching.
tuning in and watching, and we'll go from here.
Talk to you soon.
All right. Thank you.
CJ Stevens and Jerry Kallitsis work for Investia Financial Services Inc. All opinions expressed by CJ and Jerry or any other podcast guests are solely their own and do not reflect the opinions of Investia Financial Services Inc. This podcast is for informational purposes only and should not be relied upon for investment decisions. Clients of Investia Financial Services Inc. may maintain positions in the investments discussed in this podcast.